So we are into earnings season, and we have a couple of stocks we can take a look at. And so we will look at some of the ones that you guys have mentioned, and perhaps a little bit of Netflix today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I appreciate your patience. I've been traveling around, as you've probably gathered, and last week I was in Las Vegas. There was a money show conference going on there. I don't do those all the time, but I do know Kim Geithler, who's the founder of Money Show, and I knew some of the other people, like Larry McDonald, who's a former bond trader at Lehman Brothers, and Ed Yardeni of Yardeni Research, Louis Navalier, a couple other people who were speaking there, and I thought I would participate. It's relatively close by, so I would do that. They're actually doing another one here in August in San Francisco, which will be driving distance for me, so I'll probably do a panel after the close for that as well. So, over the weekend, I was taking a look at Netflix. So we'll just take a look at Netflix because this is one of the names that has actually reported already. They reported back on July 16th, if memory serves. Let's double check that. It was indeed July 16th. We can see that the stock fell a pretty good bit on the back of that. It's down about 7.25%. And I was kind of thinking about this because technically it's not a screaming buy here, but I thought we would just talk a little bit about fundamentals and a trade structure that might make some sense here. So, just looking at the technical indicators that have performed best over the course of the last year or so, we can see that it's pretty over, all of these that I'm circling in yellow right now, all of those have bearish positions on right now. RSI indicating perhaps it's a little bit oversold. There's a couple indicators that are bullish, but let's leave the technicals out of it for just a moment and think about how we feel about the company. So they have 325 million subscribers, so basically they're preeminent in the streaming space. As all will know, they recently began advertising, which admittedly when I first heard that I thought, you're pursuing a business model that is, more reflective of legacy media, and you kind of don't like to see a business going backwards, if you will. But in fairness, they're looking at probably doing $3 billion worth of revenue on advertising this year, and it's growing at a pretty good rate. And by the way, in case you're interested, you can get that information from their investor relations website. And I actually was looking at their release from their most recent quarterly report, and they highlighted that. Let me see if I can find where I was looking at it. This is the letter to shareholders that I was taking a look at here. And yeah, it was right down, where was it? Right here. This is it. So I should actually blow this up. It's going to be really hard to read. So this section right here, improving monetization. So this is where they highlight the fact that it's looking like it's probably going to be up to $3 billion in revenue for 2026. It's a $300 billion company, so you might say, well, that doesn't really matter that much. But here's the thing. At their current CAGR, this could be perhaps $10 billion in revenues by 2030, right? And let's assume that they can make like a 35% margin on it, which is about in line with what the company's been achieving. So 35% margin on 10's $3.5 billion in net income in 2030, and you throw, say, a market multiple on that, and you're looking at $70 billion worth of enterprise value on a current enterprise value of about $300 billion, which brings me to something else, which is how is the company being valued even now? And the answer is it has been cheaper, but not often. And when it has been, That valuation has coincided. So let's just look at it on a forward price to earnings basis. So I'm going to hide some of this other stuff here for a second. We'll get back to this. But just looking at the last 10 years, so this is where the valuation is right now. Okay, so it's about 18, just under 19 times. Let's call it 19 times forward earnings. Has it ever been cheaper? Yes, it was 15 times. As you can see back here in 2022, this is when the S&P had an intraday bear market. The Qs, and some other things definitively fell sufficiently to be considered a bear market, if we will. So has it ever been cheaper? It has been, but not much. And one of the things that helps us think about is we could say, well, do we think it's going to get any cheaper? Number one, do we think the operating results are going to degrade from where they are right now? I don't think they will. And do we think it could get cheaper? Well, let's just acknowledge that it could for the sake of argument, right? So let's just say for the sake of argument, it could get down to 15 times forward. That's a 20% decline from where it is right now, give or take. Which gets us down to, whatever, $56, $57, something along those lines. I don't think that's likely. I don't think, we're going to be able to perfectly time the bottom, but I would be inclined to start looking at perhaps selling some cash-covered puts in this thing, starting to pick up some of the stock, and then ultimately looking for opportunities to potentially sell some upside. Another thing one could do, and something that I talked about, is sell strangles on it, but covering the upside so that it's essentially a covered strangle. We'll go into options play to illustrate this. And, or will we? You guys have seen this a million times. For whatever reason, my password to this never seems to save correctly. And unsurprisingly, you'll see here that, options plays technical indicators, much like all the ones that are tracked by Bloomberg, not great. But really what I'm looking to do here is, sell some premium around this thing. Because I kind of like the valuation, if I'm going to sell calls, I want to sell them up a good bit, maybe something like a 20 delta call or lower, so we'll call it the 79s, and maybe sell something like a 68 strike put here. Put, call, there we go. $2.65 is what you would collect on that. Kind of a range-bound thesis. There's not going to be another earnings call between now and expiration. And then as a potential hedge, you could potentially buy something a little out of the money up here just to protect the upside in the event that things get a little, maybe pay a quarter, and you end up with a structure that looks a little bit like this: $2.40. $2.40 on a $70 stock over the course of 40 days. So we're looking at 3.4% ish over 39 days to be, we'll call it 38 if this thing opens here, right? So if tomorrow you can get this thing off, you're going to be looking at an annualized rate of return of about 30%. And, when you hear me talking about strategies like this and think, well, that's not that exciting. I want to trade options so that I can make 2x, 3x. I was talking to somebody I know who hasn't had the greatest year trading. And when I asked about the kinds of trades that he was doing, he admitted that he was probably taking on a bit too much leverage, a bit too much risk. He was trying to punt it around pretty good. And when I asked why he wasn't taking a strategy more like this one, he said, well, I had a couple things go on. I needed to make more money. Well, I hate to say it, but of course this should be self-evident, but the markets are not there to meet one's financial needs. It's really up to us as investors to try to go out and see what we can extract from them. And, I'll give you an example of some performance returns. And, there's a couple hundred trades in this, but, this is a fund that had the pleasure of working with my friend and colleague Carter Worth on. And what we're looking at here is the distribution adjusted net asset value of that fund. And the more important part that I would try to get people to focus on is this bit over here, which is that in just 61 sessions, we're running about a 4.5%. This is through Friday's close, and that's because the net asset value, just we update that after the close each day. 4.5%, essentially, in 3 months' time. And at no point, you may not be able to detect it from this, but at no point did this thing have a peak to trough drawdown. So that means from a prior peak to the subsequent lows, did it have more than a peak to trough drawdown of 0.96%? It has an annualized volatility of 4, and that's essentially doing this: selling strangles, hedging the upside. Now, in fairness, it's not just about strategy; it's also about the guy who's picking the stocks that you do it on, and for that, we have to give credit to Carter Worth, because he's done quite a good job on that score. For all of the strangles that he sold, he's actually been either called out of or put the stock very rarely. And we're dealing with probably an average days to expiration that's a little bit shorter than what I'm talking about here. I think his average days to expiration since inception is something like 17 to 19 days. But if you do something like what I was just suggesting, we'll call it 38 days to expiration, because we're choosing strikes that are a little bit wider, you don't have to carry it all that way. You can wait 3 weeks, and by that time, one or both sides of that thing are going to be close to worthless. You cover it, move on, and do something else. So it's not the most exciting thing. I know a lot of people like to tune it. Everybody wants the get-rich-quick scheme. But those are pretty solid rates of return, and really it stems from the fact that implied correlation, something I've touched on before, is quite low. Not as low as it was a little over a week ago. So it actually ticked up last week in the middle of the week when we got that little pop in the VIX. Things sort of conflagrated in the Middle East, but it's still very, very low. And what that means is that single stock options premium relative to index premium is still elevated, or you could think of index as being exceptionally cheap relative to constituent vol. It doesn't really matter which way you think about it. Just know that if you're going to look to collect premium, 0 DTEs in the Qs is probably not the premium I'd be selling here, or in the S&P. I'd sooner be a 30-day, 30 delta put buyer in that, paying away some portion of the gains that I'm getting in a short vol book on single stock, and just have a little bit of a correlation play going on there. Okay, so with that, Netflix, the name that I was thinking about this weekend. So with that, let me take a look at some of your questions and see what we've got here. Ranjana Gupta. Hi, Mike. Soon after its quarterly earnings release, I sold a 330, 340, 480, 490 iron condor in Taiwan semi for a 2.25 credit. It was my first iron condor. Please analyze my trade. What do you think of the 3.5 to 1 risk-reward ratio? Okay, so let's take a look at that. So the first thing I would say, and first thing I will say, not that I would say, I'm here saying it, so I don't have to talk about what I would say. Just go ahead and say it. The first thing that you want to take a look at are upcoming catalysts in a stock, and just making sure you didn't mention the expiration, and that could be important. So I am a bit curious about that. I can probably figure it out by figuring out which expiration iron condor would be trading for that amount of money soon after its quarterly earnings release, but maybe you can share that with us. That would be helpful. The thing that I'm most interested in is making sure that I'm not selling premium into a catalyst. So that's sort of one of our core criteria for our short premium strategies. So we will take a look at that in just a moment. But in the meantime, let's just take a quick peek at, so when was their most recent earnings? Also on July 16th, same day as Netflix. So we will choose the 17th as our start point and see what we've got. So August 10th, we're going to have a sales and revenue release. So that's a potential catalyst. So I'm curious to know whether the expiration you sold captured that. Now what's interesting is that if you were selling a 45-day to expiration strategy, then you almost certainly would have. I can tell you that in the fund that I was just highlighting, we probably would not have sold something that captured that event, and would have instead focused on selling something more near dated, just to avoid that potential catalyst. With respect to the risk-reward relationship, because we're selling naked strangles, sometimes we don't really look at the risk, at the basically at that ratio, at the payoff risk-reward ratio on the short call spread, or the short put spread for that matter. We simply say, look, we're willing to buy the stock at the short put strike. We don't think it's going to go above the short call strike. We buy a long call at the lowest possible cost just to give ourselves some protection against, I don't know, a short squeeze. We're not typically selling upside on names that could have an unsolicited bid for the company. So that's not usually a factor. So I don't really think about it that way. Instead, I think about the risk-reward relationship based on the probabilities that I could either buy the stock at the put, sell it at the call, and the annualized yield, effectively. So in this particular case, if you did it shortly after earnings, you're getting 2.25, and I'm guessing from what you're saying here that this was probably pretty short-dated, because 2.25 on a $400 stock isn't a massive amount of premium. So you're collecting, call it 56 basis points. Generally speaking, I don't like to take really much equity risk for less than what I think is an appropriate rate of return for equities annually, and I would adjust up probably for a semi, but let's call it 20%. So I would have been interested in selling anything that did not capture this, which would be up to the weeklies that expire just before 8/10. And so if you did this on the 17th, that's going to be like a 3-week trade, let's say, right? So we'll call it a 21-day trade, and I'm looking to collect something in the neighborhood of 20% annualized, probably, if I'm selling strangles on something like Taiwan semi. So 17, let's see, we'll call it 20%. That's going to be $80 times 21 divided by 365. You're looking to collect about $4.60 in 3 weeks. So if that was like a 10-day trade, 2-week trade, that's probably fine. Also because you're covered on the wings there. But I would probably have been looking for a strangle in the neighborhood of $4.60, net of some upside hedge leg, which would probably be about 50% on the money, just as a total precautionary measure. And also because in the funds where we do this kind of thing, we can't take naked short upside. But I think that's fine because, assuming that you weren't capturing this event, you chose strikes that are pretty far away from the money, right? So $400 stock, you're short the 340s, $60 away to the downside, $80 away to the upside, 20% away. Likelihood that the stock's going to make that kind of a move is pretty small. Well, let's take a look. Again, I don't know exactly how far out you went. So if you could provide that for us, might be helpful. But let's say, go like something like that. So you're short this call. And, I mean, the put you're short isn't even really on the screen. So it definitely seems like a pretty high probability trade. This, of course, is only going out 2 weeks, though, so maybe it was more than that. And, oh, by the way, this is not distinguishing whether there's a catalyst or not a catalyst. You're doing this after earnings, and presumably, in that case, the moves are going to be smaller, right? So I think the trade is fine. Kirk, good afternoon, Mike. Hope Las Vegas was fun. Little trip for you. I'm concerned about Amazon. I hold shares at about 231. Yeah, Las Vegas was fine. When I go there for something like this, where I have a couple presentations, it's not like I get to go out and get too rowdy. So, it's really, you go out to eat, you listen to some other people speak, which actually I can rather enjoy. And frankly, there's not much reason to be outside in Las Vegas at this time of year, I don't think. But August regular way, Ranjana. Thank you for that. Okay. So that actually is helpful. I'm going to, so if it's August regular way, this is going to be more like 30. So in this case, you're basically, now you're short this option. And, yours is really tight because this thing's only $10 apart. It's a quarter point, it's 2.5% of the current stock price. So you're basically short that, long this, and then you're short something way down here, which is fine. So the put side, I like skewing them a little bit higher up so that I have if I'm doing it on a stock I'm fine with, I like having the put a little bit closer to at the money, kind of like what I just did in the Netflix example. Looks like there's a little bit of gap in the histogram here. And, based on these events, that suggests that actually owning a little bit of upside is probably fine. I probably would have just sold the put, although I don't know if that has an impact for you from a margin perspective. We do our stuff on a largely unlevered basis. No, that's, by the way, how I would represent those returns as well. That's unlevered. Okay, so as for Amazon, let's take a look at Amazon. Amazon's generally a name that I like. Let's see here. So you are long at 231. It's where it is right now. So I don't think you're right. You're right there. You're up 39 cents as of the close. Look, I like Amazon. We'll get to this in just a second, but Amazon has good top line numbers. It's a reasonable valuation. You're dealing with low double digit growth. You've got $11.50 is what they're anticipated to do next year. Let's just call it 230 and 11.5. So it's trading at 20 times with 13.5% anticipated year-on-year adjusted EPS growth. The free cash flow numbers, obviously, like everybody else that is just spending like drunken sailors on AI. Massive CapEx. I mean, it's it's quite extraordinary when you start talking about CapEx that could almost be reflected in whole percentages of U.S. GDP. It's not quite there, but I mean this is 2/3 of a point of U.S. GDP that Amazon alone is spending. The big difference for Amazon, though, is that they have a big data center business, right? So AWS is already a huge provider. I don't think they cannot do it. The beauty of this is that they can support it. I mean, you can see they're going to do an anticipated $267 billion in EBITDA and almost $1 trillion worth of sales next year. And if this proves to be a mistake, they can just stop doing it. And that's a very different thing than Oracle, right? So I know different people have, a lot of people will say that Oracle's kind of a levered play in this area, and stock got a little bit of a boost today. My issue here is that, Oracle's taking on quite a lot of debt. That's a little bit of an issue. And the other issue is that a lot of the money that they're spending is on the basis of this arrangement that they have with Open. And, you see some fissures emerging between Open and Microsoft. Whatever I don't know what anybody else's beliefs on this are, but, Sam Altman, not the most popular guy in the world. I have never met him. I can't speak to his integrity. But it does seem like there are some who are less than enamored. And, it's a difficult situation if one of their biggest customers was in turn depending on, considerable business from, another multi-trillion-dollar company, Microsoft, and that starts to crack. So that's a little bit problematic. Nice that it got a boost here for Oracle shareholders, and obviously it is a more levered play. So if things work out for them, I would expect that it would outperform to the upside. But that's just a little bit too risky for my blood, and I'd rather be in Amazon. Despite the fact that this one's trading at call it 10 times forward earnings. Okay, so let's see what we got next here. So you're also asking, do I think you need any protection for Amazon? Well, let's take also a look at that and how you might give it some thought. So the ways to think about that is, first of all, how much does this thing typically move on earnings, and how expensive are options going into the print? What would be considered a bad outcome? So they're going to be reporting this week. One-day move, average 5.6%. Let's just go from -2 to +1. Why not? Do I want to do that, or maybe go a little further out? We'll start with this. 5% move, and if we go out to regular way expiration, that's going to be the 21st. Let's see. 20. I don't know if it'll let me do this. Didn't used to. Used to not let you go that. I'm just going to go this way. Say a month after. Month after earnings. 8.5%. All right. Well, if you are concerned that 8.5% move is going to be to the downside, and we've seen that there have been a couple, right? So this was 16.5% drop following earnings. 16, 16, 20. I mean, that seems to be about as bad as it gets, right? Not common, but that's about as bad as it gets when it does happen. With that in mind, we kind of have something to work with. We have kind of a range that we can do that. We can look this on the histogram also, but I'm not going to bother with that right now. Instead, I'm just going to say, okay, if you wanted to put on a put spread that captured that risk, you could go out 30 days or thereabouts. It's going to get you the August 28th weeklies, maybe a little bit less if you just want to go to the regs. Buy something like a 30 delta put, and then That's going to be the 220s, which is pretty tight protection, really. And let's see here. 5. Maybe get the 197, 195s or the 200s. Those are your choices, huh? I mean, you could pick up something like this, $4.50. It's going to cost you a little, oh, you know, you're looking at about 2%. 2% of the current stock price just to put on a put spread and hedge it if you wanted to. If you wanted to sell an upside call to finance that, so you have a little bit of a put spread collar on. You only need to, let's see, what do you need to sell here? You could sell like the 250s. I don't really even think you need to do something quite as tight as all that, just to mitigate the cost a little bit. Just cut it in half, maybe. Sell something like these 260s here. All right. Now you're laying out less than 1% of the current stock price. Get protection down around, we saw that in the bad cases, that's about as bad as it got month after. So you're going to basically degrade your returns by 1% of the current stock price for the better part of a month if it helps you sleep better. So put spread collar to me probably makes the most sense. And something like that, you know, sell less than a 20 delta call, give yourself some room to the upside. That's why you own the stock in the first place. You own it here. And yeah, I think that would be a fine way to hedge it if you're so inclined. Okay. I see you're asking, Kirk, also about PlTR. I think we can come back to that, and Nvidia, both probably deserving. Finwest, aloha, Mike. My week on the mainland finished, and now back on island in the thick of earnings season. Exciting opportunities. Yes, I would quite agree. My family is going to be flying out to Hawaii on Friday without me, because someone's got to work around here. So I'm not going, but they are. They are not going to Oahu this time. They're going to be in Maui, I think. Okay, so let's see here. Let's see. What? Kamal, you're asking, what platform are you using? Well, this one is Options Play. If you are asking me what this one is, this is a Bloomberg terminal, which I don't encourage. So we use this for our books and records as well. So, you know, for trading, you know, we do a lot of institutional stuff on the platform. We interact with a lot of firms, and in fact, for our workflow, this is essentially the only easy way to do it. It's not even that easy, but it's the principal way we do it, because when we do block trades, we need to negotiate with dealers, communicate with brokers, deal with the primes. That would be the investment banks, Goldman, JP Morgan, everybody else. But for the dealers, the best way to interact with them is through RFQs, requests for quote, on a block trade, if it's a complex order in options. So that means essentially you solicit multiple dealers and get them to go into competition to give the best price on the other side. They cannot see what the other person is offering or bidding, but I can see all of it. And you know, I can shop something around for, call it 5 minutes, and if I see a price that I like, then I can, you know, put the trade up that way. And the reason I bring this up is because, you know, people like me are using the Bloomberg terminal for reasons that are probably not appropriate to most individual investors, and therefore it's not necessarily worth the cost for most retail participants to use it, since it starts at, you know, I'm not sure, but you have to get some, you know, live market data, stuff like that, and some other features basically to use it the way I do. I'm certainly not paying as much as I used to. many, many years ago, I think it was running me about $4,500 a month back in my canner days, but it's probably $3,000 a month in its current configuration. And that's with a bulk discount because we have, I don't know, 60, 70 Bloomberg users probably. I actually don't know the number offhand, but I'd probably guess that it's something like that. So we spend a decent amount of money with Bloomberg, but you know it's very common in the institutional world to use it. But it's not necessary because it's aggregating the data. You can get a lot of the same information that I'm showing you here from other sources. Your own self-directed brokerage platform probably offers you a lot of the same things, whether it's Interactive or Schwab or Robinhood, one of those. I'm sure those platforms have all gotten a lot richer over the years. And so the other things that I use this for, APIs and stuff like that, even that stuff is available elsewhere. But yeah, so this is a Bloomberg terminal. You'll recognize it now. Whenever you see somebody else using it, you'll know it right away because you can customize it. So I'll actually show you what I mean by that. So for some charts, for example, I can create a custom chart with my own chosen color palette or whatever. So you can see this is kind of customized here. But one of the things you're going to notice is that all of these buttons, these little green and red buttons up here, the orange on black palette that Bloomberg uses, which they have used for as long as I've used the Bloomberg terminal, which actually dates back to before it was something you could have on your computer. They used to actually, it was hardware that they would bring. So, you know, they were usually shared inside of an office, and ours was shared. It looked a little bit like the first Apple Macintosh. You know, so it was a dedicated device, had its own unique, actually you can sort of see this here. I don't know, maybe I can pull this up. Maybe I can, I'm not sure. Has a unique keyboard with all these colors on it. So you kind of know what you're looking at. And yeah, the first Bloomberg terminals, you know, it was actually dedicated hardware that you would have brought into the office. And then, you know, and it was just that one machine. Then they came out with something called Bloomberg Anywhere, which meant that if you had a biometric sensor, this has a finger scanner on the keyboard, and then I have an app that has can just use the facial recognition technology of the phone if I'm logging on to some other kind of computer. So now they have Bloomberg Anywhere, so you can log on to it pretty much anywhere, which is a big help because when you travel, it's not handy to have to bring dedicated hardware. In fact, it's not possible. But yeah, founded by Michael Bloomberg. I want to say it was in the late 70s, maybe the early 1980s. If I remember, he was a bond trader at Salomon Brothers and just thought that it was kind of ridiculous that everybody was trading, you know, just on sheets of paper, and he just wanted to get a lot of information specifically about the credit markets out to people, and it's just turned into what it is now. I don't know how many users there are on this thing. It's probably 400,000. Gives you a sense of just how big a company Bloomberg is. If you figure it starts at $3,000 a month and there's 400,000 subscribers, you do a little quick arithmetic and you realize there's a reason that Michael Bloomberg is on the Bloomberg. Actually, he may not be. He's probably not on the Bloomberg Billionaires Index now that I think about it. He probably excludes himself, just like the Forbes family used to exclude themselves from the Forbes 400. But he is on the Global Billionaires Index, and that's the reason. Okay, so let's see here. What we got here? Let's look at PlTR, actually. I was looking at PlTR late last week, it should be said, because I kind of feel that there have been a few names, high-flying names, that have sort of taken it on the chin after earnings. I was kind of thinking about Tesla, and I thought, you know, PlTR could potentially also be vulnerable. Just because people have a tendency to set the bar very high, and when the bar is high, sometimes the upside is limited, but any kind of a disappointment and you get sort of an asymmetric move to the downside. The other thing I was kind of looking at here is that the one-day move, the implied move, is really more in line with what we've seen over the last 4 reported quarters. So you can see these moves have been a little bit smaller, 7 to 8% over the last 4 quarters. But you can notice that prior to that, I mean, this thing whipped on earnings. I mean, those are one-day moves, right? Down 12, up 24, up 24, up 10, down 15. I mean, these are some big moves, down 21% over here. And so it did occur to me that it may make sense to hedge it up a little bit going into the print here as well. Maybe with a trade that's not dissimilar to the one we just talked about in Amazon, and for a similar reason. You know, the options are not cheap in here, but they are at least reasonably priced compared to how this thing has historically moved around. Let's take a look. So, if one just wanted to do the put spread part, so you're kind of speculating on the downside, again, I would probably be looking out, not going out too far, something like a 30-day option, 30 delta, something like that. So that's going to get you to high volatility as this is. That's going to be something like a 120, 121 put. That's probably a little on the low side. But maybe we just bump that up a little bit. We'll go to 122s. A little less than $6. And yeah, maybe something like that. So you would do something like this if you were, oops, I'm going to buy 120. Oh, got the wrong expiration in there. You would do something like this if you were just making the bearish bet, right? So we're looking at a $12, $15 put spread, something along those lines. And if you own the stock, then you could also think about trying to offset, I would say some, but again, not all of the potential upside. You know, right here we have a long-term moving average, so you probably would expect a little bit of resistance up and around that level. So maybe you could do something like that. That looks like that's about 150, right? So you put that trade on. This one actually gives you a little bit of a tailwind. In this particular instance, you're going to actually get a little bit of premium if you use that upside long-term moving average as a potential area of resistance, and get yourself a little bit of downside protection as well. Yeah, you're going to collect 77 cents. It's not a whole heck of a lot. So, I mean, I don't think of that 59 basis points. I don't think of that as, you know, 6.7% premium yield on a stock as choppy as this one. It's, you know, every little bit helps, I guess. But it's not an income strategy. I'm just picking the strikes based on the technical levels there, and doing it very crudely. Long-term moving average, resistance, sell the upside, buy a little bit of downside protection. Okay. Oh, Nvidia. Yeah, that's right. How could we ignore that one? I feel like Nvidia is just trundling along the law of large numbers here. And, you know, it's just really, really tough at a point like this. It's not that the fundamentals don't remain strong. Producer Jay can get in my ear and he can say whether, you know, he still views this. I mean, I want to do an upgrade to the next gen GPU in my machine. So I guess that'll be the 6 series. Is that the Blackwells? Not sure. I keep looking at the prices and the prices for memory, which are just off the hook in terms of expense. But, you know, this is a remarkable story. And if you're concerned about all the CapEx that some of those other, you know, companies are spending, well, here's the recipient of all of that. I mean, look at this. Free cash flow of almost $300 billion. Almost, you know, remember I was talking about it in terms of U.S. GDP, where it's almost 1% of GDP. Net income, almost 1% of GDP. using $32 trillion number. That's just astonishing. But how long can it last? How long can a business sit there and earn gross profit margins of almost 75%? It's a lot to ask. And, you know, we've had other massive spending sprees in this country, huge build-outs. We did it with the railroads. We did it with fiber optic and telecom cabling and the internet. But these things tend to be cyclical, not persistent. So I think the reason it's struggling now is not because people think that this isn't true, that the company could make close to $13 next year. And if they do, they have a tendency to beat their numbers. So let's round it up. We'll call it $13, right? Why not? I believe that. That's 15 times. 15 times forward earnings on a 45, that would work out to about a 45% year-on-year adjusted EPS growth rate, which is insanely cheap if it was going to last like that. And the stock price is simply telling you that it's not going to continue to grow at that rate. Because how could it? If it was going to grow at that rate, the thing is going to be, at a 45% CAGR. You got something that's going to be tripling every 4 years or whatever. Is that even tenable? Well, no, not really. Because then you're going to be talking about 1.6, 1.7 trillion in revenues in 2030-ish. Really? That's actually be a little longer than that. Call it 2031, 32. But still, I don't think many people buy that we're going to be dealing with that this company alone is going to be 2% of U.S. GDP. You just get to a point where the growth rate has to slow. I mean, at that rate, I mean, it would be like the movie WALL-E, where there was just one company. In this case, it would actually be a relative handful, and maybe that's not a terrible representation of how things are going to look. But between Alphabet, Meta, Amazon, Microsoft, Nvidia, Micron, and a handful of other businesses, I mean, they would be a huge percentage of the U.S. economy. And, the railroads were once upon a time too, but I think you have to kind of anticipate that that's going to slow. So I still like Nvidia. I believe that these numbers are probably accurate and they are going to hit these numbers. It's just that I don't think that the growth is going to persist in, the coming 5 to 10 years the way they've enjoyed it over the past 5 to 10. So hope that helps. And actually, I'm actually curious. I mean, we obviously do have positions in Nvidia. Nvidia is one of our largest positions across our funds. Probably have, I'm not exactly sure, but if I had to guess, we're probably in the 1.75 billion of Nvidia stock right here across the fund. So it's not like we don't have material exposure to it. I'm just trying to explain what I think is the reason for the price action we're seeing. Okay. That was Nvidia. Didn't they just announce an intent to offer satellite cellular services? This from Tucker D. Dog. Amazon. Okay, that's about Amazon. Did they? I missed it. I not sure how I missed that, because that seems like fairly big news. But UPS to report with Amazon wind down in the rear view. Amazon low Earth orbit files to deploy up to 5,100 satellite constellation. And they're going after Starlink. Oh, really? I mean, that's good news for consumers. I don't know. Actually, you know what? Let me. So, I guess we have to see what Blue Origin is going to do. Are they planning to get that mass into orbit? Because that's a lot of satellites to throw up there. And most of the satellites that are going into space are on SpaceX rockets. And in a distant second place, Chinese rockets. So I assume all that's launching from the United States. Maybe they think Blue Origin's going to scale up and they're going to somehow become competitive with SpaceX. That's a big ask. Consumers are the winner in that case, if they do that, and I think that's good. I'd be very curious to hear about some of the specs, both up and down in terms of speed, but that's good. FinWest, I added. Okay, let's see. Oh, okay. Packaging Corp of America. So, Packaging Corp of America. So, FinWest, did I put that on there? I added, yeah, PKG. So, this is a company I spoke of a while ago. And so, anybody who didn't see that earlier stream, I don't know, maybe we can figure out which one it was. You can go back and take a look at it. This is one of the oldest companies in the country. It actually dates back to the 1800s. And, one of the things that occurred to me was that you have here one of the oldest companies in the country that benefits from one of the newest industries, which is everybody ordering things online and having it delivered. You get a lot more stuff in boxes now than you ever did, I promise. And not just because you shop at Costco to try to save money here and there. I mean, look at Walmart's online sales numbers and Amazon sales numbers, and so, you can just see it. A lot of everything is shipped in a box, and they make them. So they win. And I think that's one of the things that I believe is important for investors to do is to sometimes try to find older industries that aren't going to be put out of business by the changes in the way our economy functions, but are well positioned to continue to benefit from it. This is one of those companies. And of course, the other thing is that it's probably a little bit less cyclical and not terribly valued. Look, 23%, if you're looking down here, 23% adjusted EPS growth, solid free cash flow and free cash flow growth. So, we're looking at probably a 4% free cash flow yield, and that's right there. I mean, that's looking like a 30+% year-on-year free cash flow growth number. Keeping pace with the economy and then some, decent margins. Super exciting. Going to change the world? Not necessarily, but they've been a part of a changing world for more than a century and probably will continue to be. So definitely like that. Kirk says, does Moore's Law apply to Nvidia? And I don't actually know. Moore's Law had to do with the number of, basically how powerful chips could become and at what pace that improvement would continue and accelerate and so on. And it turned out to be pretty prescient. Just, how much can you get onto a chip and how powerful can they become? I will say that, and I've got actually somebody who's in my ear right now who knows more about this than I do, more technologically savvy. But I think that when I think about CPU enhancement, it felt as if you did not need to upgrade every single cycle. That it would probably be a little bit too expensive to upgrade every single generation cycle for CPUs on your working PCs. But if you fell 2 generations behind, you actually had a real problem because the software was getting, was optimized for much more powerful machines. And, my sense of it on the GPU side is that, if you have skipped a generation, that's probably fine, but you can't really keep up the pace if you skip more than one, maybe two. And I say maybe two only because these things have gotten so much more expensive. I was looking at Blackwell's. You can look on B&H and this and that. And I mean, these things are expensive, and memory is really expensive. Memory was kind of a non-factor for a while. I didn't think of it as a consideration in machines and cameras and whatever. And now it's incredible. You think, oh, I can record RAW. Yeah, you can record RAW, and you're chewing up 2-3 terabytes in 90 minutes worth of raw video. That gets expensive quickly, and the machine that needs to process all that gets expensive really quickly. Every single time you look this way or that, it's like you have to buy a car to get your work done. And that seems, which I guess is, also how much a Bloomberg costs. Maybe that's just what everything costs. I still thought the steak that I bought at Costco over the weekend was reasonably priced. Certainly it is compared to the grocery store. Okay, so let's see here. Alex, I was looking for a new Nvidia GPU since October, hoping for a Christmas sale. No luck, all sold out until last week when I got a discounted price from B&H. Okay, yeah. So, you're looking at B&H. I am too. I get a lot of stuff from B&H. I used to get machines directly from Dell, but I'm probably not going to do that the next time. But I'll take a look at B&H. Maybe there's another good price there. So, all right. So, Michael Anthony, how are you? So you want to take a look at this one. Simply good. Double bottom. You're referring to a double bottom. Could this double bottom last Friday that now has a rating of Fidelity now has a rating of 7.2. I don't know what that means. Fidelity has some kind of a equity rating system. Is that what this is about? You please elaborate, because I don't use the Fidelity platform. I don't. If they have research or they offer it to users, I don't know anything about that. Most of my research comes from the sell side. That doesn't necessarily make it any better. That's not a suggestion that there's something really special in that. But let me just take a look. Are you just looking at something really recent on this chart? Is this what you're referring to here? It looks like it violated that, first of all. If we were thinking, and I don't know if that's what you're referring to. Don't follow the company myself. So let's just take a look at what some other technical indicators have to say about it here. So these are the most successful technical indicators for this one, ranked by their rate of success. Now, just a quick point. Whenever you're doing something like this, we have a stock here that has rolled over. It's gotten a lot cheaper. It's not surprising then to see a situation like this. Buy and hold's not even going to show up because the stock is down so much. But because the stock has just basically fallen off a cliff, anything that was bearish is going to leapfrog to the top in terms of its performance. So Michael Anthony is saying, this means that a 7.2 is bullish that didn't have a rating until last Thursday. Yeah, so from a technical standpoint, not great. We can see where, you know, this is where the sell side is on this. Now I'm going to draw a line through Hedgeye for a second. So we're going to ignore that one. Not because I don't respect some of the folks over at Hedgeye. I do, but they are not coming from the same place. So all of these other outfits are sell-side firms, institutional, banks and brokers. And that can be a good thing. It can be a bad thing. Stifel came out today with a buy rating and a $20 price target. So, you can see this little, I would actually have to call them. I'm sure we have access to them, but I would actually have to call them to get that unlocked so I could pull that up. This, by the way, is when you see this little tab right here, that means that those firms are willing to share their pricing models with, they have it in Excel. They will share it with their institutional customers. I assume we probably get something from Stifel, although we deal much more with the primes. I know we deal with Morgan Stanley, but they suspended coverage on it. Not a huge company, so the coverage is going to be a little bit more limited. The other thing I would say is that, so there we saw Hedgeye had as a short. You don't get that from the sell side. Simple ratings from the sell side: buy, sell, hold. Sometimes it'll have strong buy, buy, hold, sell, strong sell. But you don't typically have someone who's like Hedgeye coming out and saying, we hate this thing, short this stock. And I appreciate that. I appreciate, they're not trying to get business from a firm. They don't have to worry about offending management or anything like that. They can just analyze the company, come up with their own assessment, and then, throw it out there. Yeah. So let's see what we have here. Looks like the short interest in this one has actually been falling recently. And that makes some sense, right? Because the stock fell, and it's been pretty profitable for people to be short this thing. So you're going to get some short covering in a situation like that. Still a decent percentage of the float, though. Almost 9% of the float is currently short. So you're saying that insiders have been buying from $11.88 to $20. Yeah, I mean that also can certainly be the case. So let's see. Let's see what we got here. Over here. It looks like we've had a little bit of flow in both directions. So this is the insider transactions since November. So you can see a bunch of folks bought about 107 collectively here, bought 29,000. Now, Tim Matthews was one of the buyers in November and also a seller just 4 days later, and that could have been options related. So somebody gets options, they exercise their options, and then sell some of the stock. So that could be one of the things you're seeing or thinking about. David West. So notice here also. So David West was a part of this net buy of 65,000, David J. West, but also not too long thereafter, a seller of 350,000. So I don't know. I don't see that as massive insider buying, to be honest. I mean, well, David West's big sale here, kind of offsetting a lot of what else is going on. definitely look, it's something to keep an eye on. I definitely think that makes sense. But you can see that you have these transactions. This is kind of one of the things you need to take a look at, which is it's fine to see people purchasing or getting long, but, why? Was it a grant? Was it an employee stock award or stock grant? And then they exercise and, profits interest or a call option, and then they end up selling the stock shortly thereafter. And that, by the way, doesn't necessarily mean that they're bearish on the stock. I mean, if you have largely equity compensation, sometimes people need to, they need to buy a house or do something else. So they end up selling some stock, It was $11.34 in here. So, maybe he just needed to raise $3.5 million plus bucks on the hop. And that was it. And maybe it's not a huge percentage of one's overall holdings. But, when you look at those insider transactions, just be sure that you're focusing on both the buys and the sells, because give you a more complete picture. Ranjana also saying, I stumbled on Market Chameleon website recently. Are you familiar? Seems to have a lot of useful tools for options traders. Perhaps a good topic for a future video. Yeah, maybe. I mean, look, there's a lot of good tools out there. I've highlighted some of them on this channel. I've invited people to come on. I tend, obviously, just by virtue of my work, to use the Bloomberg Terminal. We use this to communicate with other people in the business. We use it to transact when I'm buying and selling securities. And it's also just muscle memory, force of habit. But, the trend is pretty much universally in favor of self-directed investors and traders, because things that were hard to learn, hard to find out in the past are easy to learn and easy to find out now from a host of sources, often many of them free. So, yeah, I haven't used Market Chameleon. I'm not familiar with it. I think I've heard of it, but I'm sure it's good. FinWest is saying UnusualWhales provides more and better data for options traders over Market Chameleon. That I do know that UnusualWhales has a lot of data, and they collect that data, and it seems like a very good hybrid, I would say, between the way institutional traders think about things and collect data versus oops, that was a little late. Missed that one. So, yeah, I mean, it's there's a lot of good sources out there, and like I said, the self-directed brokerage platforms are also getting a whole lot better as well. But anyway, okay. Well, I have kept you guys for almost an hour, maybe a little bit more now. I apologize that I wasn't around last week. I will be around on Wednesday, or at least that's the schedule as it is currently. I will say now, while I remember it, that I am also participating on Monday. I am speaking in New York City, and I am traveling Monday and Tuesday. So I'll be back Wednesday, but probably not going to be able to do a live stream on either of those 2 days. So I'll just, while I remember it, while it's fresh, I'll mention that. But be sure to come back on Wednesday, more comments and questions. And if, by the way, you send them to us like in the comments section, or if you send me something at Michael_Co on my X handle and I happen to see it, then I might be able to prepare a little bit more for something if it's something that you think I maybe not looking at that often. But until then, like, subscribe, notification bell. Hope you guys are enjoying your summer, and we'll see you Wednesday. Thanks for watching.